Welcome back, traders and investors. We have Nate Tobik on the line, and he's an investor and founder of CompleteBankData.com. And that's a place for information on banks, banking institutions, and bank holding companies. Nate, my first question for you is how old are you?
Uh, uh, Early to mid 30s.
Early to
So
mid, so you give me a range here, right?
yeah, 33.
Okay, because I just looked on your site, and you definitely south of me. But how'd you get interested in the markets and in trading and in banks in particular?
So you know, to get into investing, I I was given a small amount of money from my grandfather, and it was just in some stocks. And for a long time, I would receive statements in the mail. I didn't know what this whole investing thing was, and I decided I'd finally learn. And so spent some time learning. And then to get into bank investing, I realized that there's this whole segment of the market that I didn't really know how it worked. And there's about 1,200 traded banks. And so learning how to analyze one bank suddenly opened up about 1,200 more investment opportunities. And these companies are all, if you could analyze one bank, you could compare it directly to another bank. And they're all in the same business. It's once you kind of crack the code to get into banking, there's just this whole landscape that opens up, and so the more I got into it, the more I realized that there there weren't great tools for people who weren't professional bank investors. And what I wanted to do with Complete Bank Data was to create a tool that could that investors could use to find great bank investments easily, and it was accessible, very easy to use, comprehensive, and it wasn't at the the Bloomberg terminal subscription level type of a thing. And so that's how I got into doing this banking tool.
Okay, and how long you been doing it?
So we launched Complete Bank Data in last November, and I've been investing since about 2005, 2006.
Okay, so you went through the financial crisis, huh? I mean, I know you didn't have your site up yet, but obviously, if you were investing in banks and doing that during the financial crisis, did you, did you get any clues that any of these banks and brokerage firms were going out of business when you were doing your research?
Yeah, so I during the financial crisis, that was interesting. I learned a lot of things during that time. One was that I went in fully invested, and I realized that I always need some cash on the sidelines because there were so many great opportunities that I just couldn't invest in. And in terms of banks, I know one. So going into it in about 2007, I had a somewhat large position in Morgan Stanley, and as it fell, I kept thinking, it's falling. I like this even more. I'll buy more. Well, we all know how that worked out. Yeah. But that was my only banking position going into the crisis, and then I really got into some of the other banks afterwards, and I've really been able to ride that tailwind as we've come out of it.
And so, on your site, what are people going to find?
So what we provide is we're not saying buy bank X or buy bank Y. What we have is we have tools over that allow anyone to go in and create these elaborate searches, compare banks against one another. So one of the things that really bugged me was I wanted most tools are built just for investors in general, and I wanted to find a screener that I could say, I want all the banks at, say, 80% of book value that have 3% non-performing assets or lower and have a 70% efficiency ratio or greater. And I couldn't find a tool that had criteria like that because no one was really focused just on banks. And so we now have those tools, and someone could go in and create a very bank-specific screen and just get back those banks.
Okay, the banks have recovered, from the financial crisis. Maybe not as much as the overall market, but what's the current investment outlook for banks? And I know it's different because you have your small banks and your big banks. So let's just talk about your big banks. What's the current investment outlook for them?
Right. So big banks are doing very well, and they've just essentially taken the market over. I don't have the number in front of me right now, but it was something like 70% of all the banking profits are being made by the larger banks, and that's growing. They have the economies of scale with the new regulatory regime. They have the firepower to really handle these regulations without costing their business anything. Whereas smaller banks are struggling because they're understaffed. They aren't experts on the regulations, and so they're having to spend a lot of time trying to deal with these things, and that's getting in the way of running their business.
Okay, so a lot of the run of the banks, has been the liquidity provided by QE. They're just getting dirt cheap money, and there's other instruments that they can go out buy, get a guaranteed return. Are doing some lending at higher rates to the public, new businesses and whatnot. Uh, with QE supposedly winding down here, is that going to put a pinch into the profit margins of the larger banks?
You know, I think it will. Right now, the rate they're paying on deposits is just rock bottom low, and when that starts to tick up, there's going to be a bit of a squeeze. One thing we're seeing though is just across the board, the net interest margin is right around historical averages. So banks have adapted very well to the low rate environment, and I think a lot of investors are worried about when rates rise, what happens. And so for a bank that's on the border of being well capitalized, that doesn't have excess liquidity, they're going to be pinched. And so they're going to have more costly deposits, and they're going to have this loan book that's paying at a lower rate, and they're going to have problems. But in general, the banking system in the US is overcapitalized. There's a lot of excess liquidity. And I think they're going to be able to take some of those low yielding securities and put them into higher yielding corporate securities or whatever fairly quickly, and and compensate for some of that for the higher rates. So I think there might be a period of time where there's some turmoil as banks adjust to this, but overall they've been very adaptive, and I think that'll continue.
Do you consider like Goldman Sachs and Morgan Stanley? I mean, they're investment banks. They really don't fit the criteria right for your site. Is that correct?
Right. Well, we pull in data on every bank in the U.S. And so everything from J.P. Morgan and Goldman Sachs is in there down to the First Bank of Kenosha, Wisconsin, or some little small bank. And but you're right. So the profit profile of Goldman is not, they're not taking in deposits and then lending out money. Most of their money is coming from their proprietary trading and all the other stuff they do. Whereas just a community bank is really living and dying on their banking franchise.
Okay, so the market's rallied a lot. Some of these banks have come back to my recollection. Wells Fargo is one of the few that have come back and made a new all-time high. How does the market value bank stocks today, and why do you think that they've been laggards in this rally?
Right. Well, that's a great question. So the market seems to value banks in really two ways. There's the short term, which is relative valuation. So in the short term, banks are going to be compared against their peers, the indexes. So right now we've got the KBW Bank Index. It's trading with a PE of 12 and at the price to book of 1.09. So if you find a bank that's trading at 2 times book, and absent other factors, maybe that's overvalued. Something at say 80% of book could be considered undervalued in the short term. And so the banks sort of hover around that index level. In the long term, the banks really trend towards like a takeout value, which could be what they might realize in a private transaction if someone buys them. And I know a lot right now, a lot of investors are betting on that merger wave that we've been hearing about since 2008. You know, uh, this trend that's supposed to happen where all these banks are going to be bought out, and we're going to be left with a dozen large banks in the U.S. And we're still waiting on that. So maybe it'll happen sometime, but it's kind of in the future. We're going to be hopeful. Yeah.
Okay. All right. Sheldon McIntyre, the virtual advisor, Herd Capital, who's a frequent contributor to our chat room, has a great question here. And I'm going to ask you about one specific bank. But do you have a view on the European banks, capitalization, emerging market exposure? And just to throw on top of that, have you looked at the chart of Deutsche Bank here? I mean, what is going on over there?
So I haven't looked at their chart. I'll have to pull that up. But in terms of European banks, they're they're what I like to call, they're flying very close to the sun. So these banks are very thinly capitalized. They do have a lot of Southern European exposure, and I think they're kind of in the mode of the Japanese banks, what the Japanese banks were back in the 90s, where they're just hoping to muddle through and that things will eventually get better. And so when you're in that environment, you start to have situations where a bank was expected to lose, say, 2 cents a share, and they only lost 1 cent a share. A small difference like that suddenly means a lot because there's not much margin there. And I think that's what we're seeing with the European banks.
All right, so let's get to the nitty gritty of things here. And I've had a nice run in the market. Some of the banks have lagged, as we mentioned. So, are there still any investment opportunities out there in the banking sector?
Oh, absolutely, absolutely. So there's still a number. I just ran a screen and found there's about 20 banks that are all selling below 80% of book value with returns on equity above 10%. So, I mean, for a bank investor, there's a small portfolio as is. There's also a number of banks that are in acquisition mode right now and growing very nicely. And what we're really seeing in this environment is a lot of acquirers are able to take out a significant amount of costs in the banks that they buy. And so they're able to buy a bank at what might be considered a bit of a premium at the sale price. And they're able to take out so many costs that purchase becomes highly accretive to the acquirer. And so some investors have really gotten on this acquisition train, and there's acquisitive banks that are really growing their earnings quite well.
Okay, and any thoughts on Indian banks?
Indian banks in India, right?
Yeah. I don't
Yeah,
think, yeah, not the banks on reservations. They get
yeah,
those are called casinos.
right. Yeah, that's a little different business model. I really haven't looked at any Indian banks. The problem is it's tough for a non-Indian citizen to invest over there. And so I don't have any links to the country, so I haven't really taken any time to look. I know a lot of them are trading below book value, but that's about all I know.
Okay, and so when you're looking at banks and you're looking at your website, what are some of the red flags that investors should pay attention to?
Right. So with banking, you know, the trend is your friend, much like in trading. And so you want to find a bank that the trend is going the right direction. And so a red flag would be a loan book that looks like it's in runoff, where loans just continually are decreasing. You want to avoid banks that have a hot money in their deposits. So this is a lot of broker deposits. It's the CDs that we see when we're on Yahoo Finance or something. It's the high yielding CDs. That's the hot money. And then the trend in non-performing assets. So you ideally want to invest in a bank where their trend in non-performing assets is getting better over time and coming down. And at this point in the market, coming out from the crisis, the banks overall are doing very well. So, what I would say is if you're looking at a bank that has a significant amount of non-performing assets, and here we are, summer 2014, I would say just that's a red flag in and of itself. So that shouldn't be something we're seeing at this point. Um, Non-performing assets overall are about less than 1% of total assets. And so there's some banks at the 3, 4, 5, 6% level. And just in general, I'd stay away from those.
Okay, and just obviously you're a longer term trader, but how much emphasis do you put on the way the banks trade in the short term, versus the long term? Do you kind of not sweat out the little things unless you're in a financial crisis like we had, or what's your outlook on the short term versus the long term?
Right. So I'm a long-term holder, but I think that any bank investor does need to be focused on the short term because since these are such leveraged institutions, their fortune could change on a dime. And so, like we saw in 2008, there were a number of banks that were earning 10, 15% returns on equity that suddenly are out of business. And so you need to be focused on the trends in the loan portfolio, the non-performing assets, because when they report their earnings, and if they say the non-performing assets went from 1% to 5%, that's it's time to sell because a bank doesn't need that many loans to go bad before it ends up under the FDIC.
Okay, and any final tips for investors? I mean, I'd like to ask you just about Bank America. I mean, here's a stock. It went down to $5. Mr. Buffett made a big investment in it. It's coming back. I mean, what's your long term outlook for Bank America?
I think all of the big banks will do well just because they have the economies of scale, and so if you ask any customer of Bank of America, I don't think they love the Bank of America, much like someone might love a local bank. But in some ways, you can't help but bank with them. Where else can you go that you could find an ATM on pretty much any corner in America? And for reasons like that, they're going to always be around. And so I think the stock will eventually reflect that. They've recovered. They're still working off some issues from the countrywide acquisition. But I think overall they'll just continue to do well, and it's that they ended up at the top of the heap, and so they're going to be rewarded for that.
Uh, one more question here out of the chat room. Does Nate see large U.S. banks spreading out internationally again and buying up big banks?
That's a great question. I know in the U.S., I don't see a lot of large bank acquisitions just because the banks are at the maximum of what they could acquire. So it's not widely known, but there is a rule as to how big a bank could be, and it's a market share measure. And so many of the big banks are at that limit. So their only possibilities for growth are organic growth, or they could grow by acquiring banks overseas. You know, I guess in some ways it wouldn't surprise me to see some overseas acquisitions. Uh, but right now, I think with all the issues that some of the overseas banks have, and the environment we just came through, I'm not sure if many of these executives are really excited to be buying an undercapitalized European bank when they just dealt with their own capital problems in the U.S. here.
Okay, all right. We've had Nate Tobik on the line, and he is an investor and founder of CompleteBankData.com, giving you comprehensive information on banks, banking institutions, and bank holding companies. Nate also runs OddballStocks.com, an investment blog that uses his research. Well, Nate, thanks a lot for coming on and great information. We hope to have you on again.
Great. Well, thank you for having me on. Appreciate it.